Hello, and you're welcome to Global Business Insights, where from a global perspective we discuss ideas and answers to questions in the fascinating places where finance, business, and culture meet. Deutsche Bank today beat expectations in its return to profit in the third quarter, with net profit at 1.461 billion euros, compared with expected 1.047 billion euros. A partial release of 440 million euros of litigation provisions for Q3 also helped boost profit. Revenues from investment banking grew 11% year-on-year. Also, a sweeping cost-saving push set to lighten the headcount by 3,500 roles. That's by 2025, also helped profits. The IMF slightly amended its global growth forecasts and now sees 3.2% growth in 2024 versus 3.3% growth in 2023, also expecting growth at 3.2% in 2025, marching this year. Still on the IMF, it said in a boost to Chancellor Rachel Reeves, that's the UK Finance Chancellor, ahead of her first budget next week, that the UK economy will grow 1.1% this year. That's a 0.4 percentage point upgrade on its previous projections. The IMF, however, downgraded Nigeria's economic growth, now expected to grow at 2.9% in 2024 from previous projections of 3.1%. That was in July, and 3.3%. That was the April projection. And all this as BRICS 2024 meetings also take off in Russia, at which Vladimir Putin is hosting 36 world leaders. Some mixed news on Q3 earnings. General Motors gave investors something to cheer yesterday after it raised its guidance for a third time this year, in addition to easily beating third quarter revenue and profit expectations. However, L'Oreal reported disappointing results in the third quarter as demand for cosmetics waned in the French beauty group's key Chinese markets. We expect results from Tesla that will be due after the US market closes later today. US stock indexes mostly slipped yesterday as rising treasury yields impacted rate-sensitive sectors, with talk of the Federal Reserve pausing on rate cuts, while investors continued to evaluate Q3 corporate earnings. Meta Platforms and Chief Executive Mark Zuckerberg won the dismissal of a lawsuit claiming they misled shareholders in Meta's proxy statement about their ability to ensure the safety of children. The International Monetary Fund said the US election is creating high uncertainty for markets and policymakers given the sharply divergent trade priorities of the candidates. Meanwhile, in BlackRock's latest weekly commentary, their analysts see the mega forces affecting investment not likely to change in any material way. What are these forces? First, the world is split between aging advanced economies and younger emerging markets with different implications. That becomes more compelling in a chat on the IMF and BRICS meeting holding simultaneously. Second, digital disruption and artificial intelligence technologies will continue to transform how we live and work. Third, more geopolitical fragmentation as we see globalization being rewired as the world splits into competing blocks. Fourth, a fast evolving financial architecture is changing how households and companies use cash, how they borrow, transact, and seek returns. Also, a transition to a low-carbon, resource-efficient economy is set to spur a massive capital reallocation as energy systems are also rewired. BlackRock thinks these are the key forces to keep tracking. We will revisit these forces after the elections as the administration, that's the incoming administration, settles. Markets do not see a material difference in the impact, irrespective of who wins, with most of the factors somewhat not going to change, and most have already positioned adequately, barring a black swan event, which cannot be completely ruled out. UN Secretary General Antonio Guterres has been scolded by Ukraine for choosing to attend the Brics meeting hosted by Putin in Russia. Presently, we have about 36 world leaders being hosted by Vladimir Putin. I looked at the latest World Economic Outlook growth projections of the IMF, listening to Pierre-Olivier Gorinchas, that's the chief economist at the IMF, where he says India, which grew 8.2% in 2023, is projected to grow 6.5% in 2025. China will grow at 4.5% in 2025, while in 2025, Brazil grows at 2.2%, South Africa 1.5%, and Russia 1.3%. Compare that to the US growing at 2.2% in 2025, the EU area at 1.2%, and UK at 1.5%, all in 2025, with advanced economies growing at 1.8% next year, compared to emerging economies at 4.2%. You can see advanced economies are growing at half the rate of emerging and developing economies. If you add the 5 new BRICS countries, Iran, UAE, Saudi Arabia, Egypt, and Ethiopia, even as Putin says BRICS will introduce new levels of membership similar to what OPEC has done to attract growing numbers of nations with a dislike for US dominance and keen to see a different multipolarity with healthy alternatives. You can see that the BRICS countries are growing much faster than the advanced economies. Putin, in his opening speech, said BRICS is attracting an ever-increasing number of supporters and like-minded countries. When Pierre Gorinchas, that's the IMF economist, said yesterday at his press conference that he sees underwhelming growth, he means for the Western economies and not for the new BRICS recruits. Indeed, tepid growth was compensated by upgrades to the forecast for emerging Asia, where surging demand for semiconductors and electronics, driven by significant investments in artificial intelligence, has bolstered growth, a trend supported by substantial public investment in China and India. Emerging economies like UAE will grow 5.1% in 2025. Saudi Arabia expected to grow 6.5% in 2025. That means the powerhouses for growth, that is those growing at over 4%, the major economies include China, India, UAE, Saudi Arabia, Egypt, and Ethiopia. They are already in the BRICS net. Though US, Brazil, Britain growth forecasts for 2024 were raised, many economies have unpredictable monetary and fiscal adjustments to execute, and in some cases quite unpopular reforms as they try to boost productivity. Trade protectionism in advanced economies makes the inroads by nations into their markets even more rough. So what does this mean for business? My strong advice for businesses, especially in Nigeria, is to have a shock-tested business model ready for supply stress at any point in time from anywhere, with clearly mapped out contingencies in response to different supply scenarios and geopolitical shifts. Also, continually watching the forces at play. Nigeria, with all the bluster, is projected to grow at a tepid 3.2% in 2025, 2.9% in 2024, still seen as a question mark with huge potential. Nigeria needs new friendship with growing markets, with a healthy consumption appetite as it aspires to emerge as a prolific producer and exporter of goods and services. BRICS Plus is definitely a space to play more actively in. Some thoughts On the downgrade of the Nigeria growth forecast, remember what Georgieva Kristalina said: forecast is not destiny. Forecasts are regularly updated based on fresh realities. And quoting Georgieva again, Nigeria can definitely do better in translating the undisputed potential to much higher value realization. Until it does that, the downgraded forecast stands as more compelling hard truth. And still in Nigeria, in a fresh bid to grow Nigeria's crude oil output significantly in the next 12 months, President Bola Tinubu, represented by the Secretary to the Government of the Federation, has launched the 1MMBOPD initiative to raise oil production by 1 million barrels per day. And this will be achieved by harnessing dormant oil assets and optimizing existing ones. Wale Edu, Nigeria's Minister of Finance and Coordinating Minister of the Economy, during a G24 press briefing at the ongoing IMF World Bank annual meetings in Washington, also highlighted the urgent need for Nigeria to enhance oil production levels to mitigate foreign exchange challenges currently facing the nation. We replay an earlier clip from a chat with industry veteran Victor Romosele, Director at the Center for Petroleum Information in Nigeria, where he shares insights on the challenges associated with growth in the Nigerian oil sector.
Every African country has oil now. I think 54 of the 55 oil countries in Africa have oil. So Nigeria doesn't have the bragging right it had many, many years ago. And so we just have to step up and do things differently and do things smartly. You have a piece of legislation, make it work and make it work fast. We have to be more aggressive. We're not aggressive enough in terms of getting investment into our own industry. I've seen many years of the industry, and I can tell you that in the last few years, we've not really made as much progress as we made many, many years back. And the reason is we are not investing enough. You invest more and then you get more. When we choose to invest more, then I'm sure we would. And then the second order reason is the fact that the PIA was delayed for many, many years. And now that the PIA is out, it's chicken and egg situation in the sense that in one way it enables, in another way it creates constraints. So how well are we using the PIA? How many new investors have we had? Not too many new investors, and even the current investors have had to have parts of the PIA tweaked in its implementation for it to work. So there's quite a lot of work for the authorities to do to move the industry forward. Recently, I'm sure you heard that when the CEO of Total Energies in a forum recently said, look, Nigeria, you do a lot of talking, but action is delayed. And that's why we're moving so many millions or so many hundreds of millions to other countries. But it's a good thing, too, that within the indigenous players are stepping up. As you do know, in a few years' time, 4 big players will now be stepping in the shoes of 4 IOCs, and that is a good thing by buying up most of the assets. In fact, it's said that about 75% or more of the assets in a couple of years' time in the Niger Delta, guess who will be the operators? Not IOCs anymore. They'll be indigenous players like Seplat, Chapal, Oando, and Renaissance. So that's a period to look at, and that will have its own challenges. We do hope we can rise to those challenges and move the industry forward.
Asia-Pacific markets mostly higher, breaking ranks with major Wall Street benchmarks. Japanese subway operator Tokyo, that's Metro's stellar market debut, also boosted investor optimism. There was also pressure from a rising US dollar and uncertainties over the US election. Meanwhile, Singapore's core CPI, which excludes private transport and accommodation, grew 2.8% in September from a year ago, slightly higher than forecast of 2.7%. Well, that's it from me on Global Business Insights. This is Bodio Shosami. Thanks for sharing and following. Thank you very much for watching. Bye-bye.